So you probably saw the headlines in the Financial Times this morning. Warren Buffett buys $3 billion Citigroup stake in value hunting stock splurge. So what were the basis and grounds of his value hunting on that particular company? What was he perhaps specifically looking at? Was he just looking at share price performance? I mean, the share price is back at what, 2011 levels, so it's back at where it was over a decade ago. Does he expect it, therefore, having been at that lower range, that it's more likely to go from current levels 46 to 80, so almost double. Maybe he's looking, well, that's not value in itself, by the way. Maybe he's looking at other factors such as price earnings, forecast price earnings growth. Well, of those three metrics, and there are other metrics for judging the valuation of a company, price earnings is the one which, when you look at diversified banks or even financial services, credit services within that sector, and regional banks for that matter, it's the one where Citigroup stands out on a PE ratio, PE ratio of 5.6. Whereas if you look at Wells Fargo, which he sold out of, you're looking at 8.78, so far higher. You look at Bank of America, 9.92, JP Morgan, 8.78. So you can sort of see why he might have gone for that. Well, what are the alternatives then? Well, Capital One Financial Corporation is at 4.48 on that basis. Discover Financial Services, you know, the Discover card, 6. But like I said, 5.6 for on PE. It doesn't stand out, Citigroup, on a PEG or price to sales or on other valuation metrics. So it suggests, and obviously chances are he looked at a whole bunch of these. By the way, one of his favorites is price to book. And Citi does sort of stand out on that as well, 0.52 on a price to book ratio. Just to give you a comparison, JP Morgan's 1.39. So Citi sort of does become a bit of a scream. The idea then is, well, in that same sector, are there others which are similar to 0.52, whether it's banks or insurance or regional banks? Well, not quite, actually. That's the one which is by far the lowest. I'm looking here, a whole bunch of others, such as PNC Financial Services, that's 1.33. Berkshire Hathaway itself, when it comes to price to book, is off the scale. I mean, it's just, because that's the thing he targets. So the chances are he probably went for price to book as opposed to price earnings, though on price earnings, they can be interrelated. They're not just exact, they're not just totally uncorrelated. I suspect what's happened is that's where Citi has become a bit of a screaming buy for him. What's my analysis and take on it? I think I could put it as a special situation, expecting it to go, given the big man's gone behind it, and value is the flavor of the month, and it's cheap buy on price to book, price to earnings, then I'd be looking at 48 to, let's get back to those highs. So we're looking at almost a 90% return, but I'd have to give it time. How much time? And don't forget, it could fall as low as that. I don't think it'll go much lower than that. How much time? I'm afraid I'd have to allow myself at least 2 to 3 years for it to get to that, hopefully sooner. But that would be the basis of a special situations play on Citigroup. Okay, hopefully you found that helpful. Look at the links in the bio and follow for more of this kind of stuff.